Hello, my name is Doug Marshall, and this is the recording or re-recording of the third week of the Business Owner Planning Series using business valuation to engage with business owners. The original recording was done with my partner, Peter Valissis, but I do the re-recording, and the purpose of doing the re-recording is to do this in a bit less time than the live version. And so we're going to breeze through a number of the concepts, but we at least wanted to, for anybody that wasn't able to participate in week 3, because of the change that we made, we wanted to make sure that you at least had an overview and knew how to contact us if you had some questions. So here it goes. These first slides I'm going to really breeze through because it's really a recap of what's been said before, but just reiterating the idea that working with business owners is lonely out there, and it's better with a team approach. This is a very large market with 10 million businesses going to transfer ownership over the next 10 years, a $12 trillion opportunity. I am making a personal observation here that I'm seeing a lot of insurance carriers and some financial institutions starting to promote sales to business owners and coming out with some really good collateral. Personally, I think that Penn Mutual is a great place to land. They do have some excellent materials if you're looking to use an insurance carrier's materials. And also the product lineup is exceptional, especially with the ACE underwriting program. I believe that working with business owners can be easier on the insurance front because of all the tools that Penn Mutual brings. I'm going to reiterate that Peter and I start working with a business owner by asking these 3 questions. You might want to pause here, just read through them. I'm not going to labor the point, but this is a great way to open up a conversation with a business owner. As you know from the previous webinars, our belief is that we start working with business owners by using valuations so that we can create a foundation for how the planning goes forward. And we believe that the breakthrough technology of BizEquity is a game changer for anybody wanting to work in the business marketplace. And as we've talked about before, we have this process for working with business owners that we call EDDIE, or Engage, Discover, Design, and Execute. And we believe that we are doing 2 things at the same time every time. In this case, and what we're going to talk about in these case examples, is that we are both doing designing and execution at the same time. In our own personal experience in working with business owners is that as you're going through the execution phase, very often you have to kind of go back and tweak the design because things change or you find out more pieces of information as you go on down the road. You're always finding out new stuff. Peter and I have been working on this graphic, and we've done a few different things with this, but the reason that we use this graphic so often is that we believe that the business is the thing that's supporting everything that's done on the personal side for the business owner. So, it's supporting the lifestyle, it's taking care of, everything that, they have for their future, their kids' educations, where they live, vacation homes. If the business fails, then it's a severe impact to the family. So that's why it's so different than working with the wealthy affluent that either inherited wealth or also have high-paying executive professional positions. This business is so crucial to the existence of this family and the lifestyle that they have. It's important to protect, and we need to understand the value of the business in order to put in the plans that will protect that business. So let's jump right into the case study here. And here's what the BizEquity valuation revealed about what I call JDM Inc. And we were able to ascertain that the owner, the 90% owner, Doug Sr., is age 60, married with a child not in the business, but also had a son in the business, and then a 5% owner that was non-family, but the CFO. We knew that the corporate tax rate was 21%. There were 25 employees. And here were the pieces of information that, we wanted to focus in on. $4 million of gross revenue, $600,000 of pre-tax income, cash of $250,000, and an equity value of $3.5 million. And as a result of our discussions with the owner, Doug Sr., we figured out that you wanted to retire by age 70 and have Doug Jr. take over the business. That Scarlett Johnson, the CFO, wanted to retire at 65, but it was important that she stick around to support both Doug Sr. and Doug Jr. in the leadership of the company. And then also, Doug Sr. wanted to make sure that Helen, his wife, and his daughter Sue were well cared for and would inherit a proportional share of the business, but he did not want them to be actively engaged in the business because they just never had been and they never will be. So with those three key planning objectives in mind, let's take a look at some of the solutions. So let's take a look at what the default plan is currently for Doug Sr. or was currently for Doug Sr. who wanted to retire in 10 years. And remember, there's always a plan in place, whether it's an official plan or just a plan by default. This is how these things work. There's always a plan that's currently in place. If we look at this graphic, we will see that Doug Jr. at some point in time will take over the business. There's a question as to Scarlett Johnson's role, and Doug Sr. is going to ultimately get bought out of the business. But because there's no formal succession plan in place or a finance succession plan, that time that Doug Sr. gets out of the business is going to be a drag on the business income. The income is going to be taxed at ordinary income tax rates. It's going to also impede Doug Jr.'s independence and leadership because this is a purchase that's going to be over time. So it's really going to be tough for Doug Jr. to kind of totally take over the company. And then the retirement income is dependent on the performance of the business, which is also something that I think individuals that are prepared to move on into retirement have to worry about, because sometimes they're not that same level of trust in their kids that they have in their self. And there's that question as to whether or not Scarlett Johnson is going to be reporting to Doug Sr. or Doug Jr. because that relationship has not been clearly established. So that's the default plan. So what might be a better plan? You might remember that they had unused cash asset of $250,000. We're going to redeploy that. And we're not going to insure Doug Sr. with a whole life insurance policy and IUL insurance policy. We're going to insure Doug Jr. because he's ultimately the future of the business. And we're going to take that $250,000 and we are going to put it into the premium deposit fund and pay premiums on both the whole life and the IUL out of the $250,000 premium deposit fund from Penn Mutual. Because I'm trying to keep this short, you might want to pause on this slide and just read all of the rest of this stuff. So that's what I would suggest that you do through the remainder of the slides that I'm going to go through. If you get to a point where I'm going too quickly, just pause, read through, and then you can move on. And of course, you are always welcome to ask me questions or get in contact with me if I have failed to describe this in a clear and concise manner for you. Now, one thing we're going to point out is we are not going to buy the entire business from Doug Sr. We are going to buy 1/2 of Doug Sr.'s interest at retirement. And 1/2 of his interest is equal to $1.575 million. And we're going to do that in a 15-year annual installment, which will be retirement income, which is really an after-tax value of the payment of 21%, which is $82,950. This means that once we make this transfer, that Doug Sr. is going to go to a 45% level of ownership and Doug Jr. is going to be a 50% level of ownership. So he is clearly the majority shareholder and 100% in charge. So here's the mechanics of what we're doing. We're taking $250,000, and if I misspoke earlier about where the premiums are going, we're taking $250,000 from the savings account that the company has. We're going to transfer that into the premium deposit fund, generating 3.5%, and we're going to buy a whole life policy with 10-pay premium of $29,000. So that's fully funded. Then we are going to ask the business owner to take less than 10% of their annual revenue and their net income and devote that to the IUL policy, a cash value funded IUL policy with premiums of $52,000 that will ultimately generate the $62,000 a year for 15 years needed to get us up to the $83,000 to buy out the 45% of Doug Sr.'s ownership in the company. So once again, we've purchased the whole life policy using the premium deposit fund and just redeploying the existing cash. And then we're asking for less than 10% of the net earnings of the company into a buyout program that's going to be much better and much smoother than the default plan that they currently have. It's not hard to get a company to solve its problems by asking for 10% of their earnings. And then this is just a page where it shows the numbers for the combined power of two policies illustration approach that Penn Mutual uses, showing both the whole life and the IUL together and then the combined results. Once again, I suggest that you pause anywhere if I'm going too quickly because I'm trying to keep this to 15 to 20 minutes in length. So here we are side by side, and we like to do this a lot. Now, for some reason, when Peter generated this PDF, the arrows did not come into play, but this is one thing that we like to do. We like to show the default plan, the existing plan, and then the better plan, which creates a much smoother transition. I think showing this stuff side by side definitely makes some sense. Just remember that in the default plan, Doug Jr. was going to move into the position of running the company, but Doug Sr. would still be hanging around, with the default plan, and there would be some questions as to whether or not Scarlett Johnson was being taken care of, or that she would have an idea of the direction of the company. And with the better plan, there was more of a clear process for how the ownership was going to be transferred. So let's take a look at planning objective number 2. We want to make sure that Scarlett is secure and has motivation to stick around until the retirement age of 65 to help with this transfer. So the default plan is just to pay competitive salary and bonuses, but that's always something that's in the future. And there is also going to be the buyout of shares at retirement. The current value is $175,000. So that's a problem because it's a drag on income. There is no incentive for Scarlett to stay per se, and it's not sufficiently compensating her for the years of loyal service that she has provided. Let's take a look at a better plan. We're going to provide a supplemental executive retirement plan for her so that once she retires at age 65, and we can put a vesting schedule on this, we are going to pay Scarlett for a 5-year period of time an amount of money that's promised to her that's going to be funded or financed by a business-owned key person life insurance policy. Let's see how those numbers work. So we're going to pay her an additional 5 years of salary beyond her retirement. That's $250,000 per year for 5 years. If she were to die prior to retirement, reaching retirement age, there would be a pre-retirement survivor benefit that would be given to her beneficiaries. We are going to fund this with $50,000 of annual premiums totaling $750,000. And remember, when we pay out the benefit, that's a tax-deductible benefit. So we don't need to take out a full $250,000 from the life insurance policy to net get her to a $250,000 total compensation. And here's the numbers of how the policy works. We're going to be putting in 15 years of premiums of $50,000 each. You can see the cash values of the life insurance policy. Actually, in this illustration, you can't see that, so excuse me for that. We're going to put in $50,000. Then we are going to withdraw $196,000 from the policy to help the company recover their net after-tax cost of paying out $250,000. And ultimately, when Scarlett dies, the company is going to get a $1,197,000 death benefit. That's down toward the end, which means that total overall cost, not taking into account time value of money, is going to be to the positive of almost $450,000 to the company. So the company has put in the premium, paid out the benefit, recovered the death benefit, which is in excess of all expenses that they've paid, to the tune of $450,000, just shy of that. And once again, if you want to talk about these specific numbers and how they work, just email me. I've got my email address at the end, or Peter, and we can talk about that one-on-one in a little bit slower environment. So once again, the default plan and a better plan. Right now, the default plan in the company is just to pay out Scarlett and retaining her with cash bonuses. Now what we've done is we've tied her to the company until age 65 with a SERP plan, a supplemental executive retirement plan that's going to pay her $250,000 a year for 5 years upon her retirement at 65. And she's got to stick around to get it with a vesting schedule that makes sense for whatever their plans are. One thing I will add here that Peter did not, I really like the 5-year SERP. So think about this. Somebody retires at 65. They're getting a continuation of their salary for 5 years. Now, why is that important, just 5 years? I think it makes sense 5 years because in privately held companies, a non-qualified plan, the person who's getting the benefits is an unsecured creditor. So there's no guarantee that they're going to get that $250,000. It's a contractual obligation of the company. But if it's only 5 years, that individual's probably not going to worry that that company is not going to be around in 10 or 20 years to continue paying a benefit. But I think an added value is this allows the individual to take less out of their taxable retirement accounts and wait until 70 and a half when they're forced to, under the required minimum distribution rules, to take out the money. They're going to have more money later on in retirement if they can accomplish it in that way. I really like that plan design. 5-year benefit on the non-qualified side, allowing them to take less out of their other retirement accounts. It can also push them out for when they would take their Social Security, which is going to make a much nicer benefit as well. And then finally, very quickly, the planning objective to provide for Helen and Rachel. So, the default plan is that, Helen would inherit the business when Doug Sr. died, with Doug Jr. running the operation. And then Helen and Rachel are going to rely on distributions from the business, probably in the form of dividends, for the income. And then Doug Jr. is going to have to work away to buy out the business from Helen through the estate. And it creates all sorts of problems because it's a drag on business income. Once again, it impedes Doug Jr.'s independence and leadership. And then, the retirement of Helen and Rachel and the money that they receive really is income dependent upon the performance of the business. And we also have that potential double taxation of dividends. And then what happens if Doug Jr. dies? There could be a panic sale and the whole plan goes out the window. It's not effective. So really what Doug Sr. wants, and this is a far better plan, Doug Sr. wants to make sure that Helen and Rachel are equally treated along with Doug Jr., but instead of getting them involved in the company, we're going to then take a guaranteed UL policy, take that out on Doug Sr., insure him so that at the time of his death, we can get rid of all of the other shares that are being owed that would be owed to Helen and Rachel, and then we can pay them the cash, and then everybody's equal. Take a moment just to kind of look at where the arrows are here. And so really all we're doing is we're taking a guaranteed annual premium under a GUL product from Penn Mutual of $54,000, guaranteeing a death benefit of $3.5 million. It's the easiest, most predictable way to buy out a business and treat the family members equally. So Doug Jr. now has the business, and then the wife and daughter who are not involved in the business have the monetary value of that business in their hands. So take a moment just to take a look at the side-by-side of the default plan and a better plan, keeping in mind that what we're doing is we're creating predictability. And so that enables not only the business owner, but the business owners, other advisors to better serve them, the attorneys and the accountants that are doing the advising. They can set up better strategies for them with the predictability that the insurance creates. Okay, so I went through this quickly, and that was the purpose that I had, was to go through this presentation quickly for those of you that just either wanted to review, or for those of you that did not get the opportunity to be on the actual webinar in the third week. But here are some key takeaways. This is a marketplace that is going to create a $12 trillion transfer. And I think that working with business owners today will give financial advisors access to the $12 trillion that is transferring. At the time that the business is ready to sell is probably too late, so you need to be working with business owners today. You can become the business owner's most valuable advisor by using breakthrough technology, using a breakthrough process, and putting yourself in a position where you have a team surrounding you, and you're working together with people who have expertise in different areas. Peter and I, from time to time, get involved in premium financing cases. Although we understand premium financing, we do not do it near enough. So we rely on partner companies to help us out with that. It's much better. They're much more efficient. So that's just an example of why working in a partnership environment really works. And keep in mind that we generated almost $185,000 of target premium from this case alone, and we solved 3 separate problems. Far too often, we see advisors out there solving one problem and missing the other opportunities, the other problems to solve. And that's what doing the valuation helps to uncover. It starts a conversation with the business owner to find out all the things that they need to have done in order to consider themselves having successfully planned for the transition of their business. And the delivery of these insurance-based plans created efficiency, cost effectiveness, and more importantly, predictability. And I like that word predictable, because that's what's the uncertain. We're looking at an uncertain future in many instances with businesses because they don't know what's going to happen at the time of sale because they haven't planned for it. So here's our contact information. You're either going to have to gain this expertise yourself or partner with experts. Personally, Peter and I have a lot more fun, working together, working in teams, because we're able to lift each other up when the going gets tough. We also now have Marshall Valissis emails as well. We'll pass that on to you later. But if you have any questions, here's our contact information. We'll spend any amount of time with you. Once again, the offer is still open for you to go in and do your own business valuation and see how the software works. Get back to me if you have some interest in that. But just in closing, thank you very much for participating with us. We hope that we can work together with you on different ideas and share some things back and forth. Peter and I always hope that we have passed along something that is educational, but at the same time, our interaction with you, we're also guaranteed that we're going to learn something as well, because you have different approaches and different ideas and you see things differently. Thank you very much. Hopefully, we'll talk with you soon.